We start off with what was a wild day on Wall Street. The Dow swinging about 500 points during the course of the day after being up more than 200 on the Dow, falling 300, then climbing back. The Dow sold off into the close, ending the day down about 200 points. Financial sector leading those declines. And it's been a bank bloodbath in just the past week. Goldman Sachs, the biggest loser here, down 13%, followed by Citigroup, Morgan Stanley, Bank of America, and JP Morgan, all under pressure as well. So what is wrong with the banks? Is the bank trade left for dead? Guy.
First of all, Tony Dwyer, he gets a special intro. Single box.
Yeah.
My family
You've never had a single box, right, in the introduction?
I have not.
Are you jealous?
I've been here for like 36 years.
Yeah, at least.
Incredible. I am a little jelly. That's what you guys say. Listen, I've tried to make what I thought was a cogent, intelligent, whatever word you want to use, argument for being long the banks for a long time now. A couple of weeks ago, I said, sometimes you're just wrong. Sometimes you're just wrong. And the banks are proving that day after day. Each one of the banks you mentioned, I can make an excuse for. Goldman Sachs feels like Goldman Sachs specific. I think this Malaysia situation is probably bigger than the market gives it credit for, and I think you're starting to see ramifications now. I also think Goldman Sachs is trying to change their business, and it's not easy to change that kind of aircraft carrier around, number one. JP Morgan, caught up in the collateral damage, not nearly down as much as the rest of them because they are best in breed. But you look at Morgan Stanley, they get in asset management, shrinking margins there. And then you look at Citibank, which is fascinating to me. Tangible book, I think, at Citibank, give or take $62.5, $63, trading about 1.1, 1.15 times tangible book. Why is that? I happen to think it's for European exposures, and I think maybe the real problem and the systemic risk for our banks comes from Europe.
Well, I'll tell you, look at all the banks. They haven't performed in the best environment. So now you get an environment that's not as good, and all of a sudden everything gets sold off. What I find interesting is people worried about a flat yield curve. Well, since August, that yield curve has steepened a bit, so the banks should do well there. They haven't. The other thing you need to be concerned about, high yield bonds or even investment grade bonds. The credit quality in those are under question. I'm not saying things are falling apart. I'm just saying as traders, you're looking at that and saying, you know what, maybe the bank's balance sheets aren't as strong as they were 2 or 3 months ago, therefore, and they haven't worked in a great environment. So now maybe I don't want to be in them.
And things could change with the new Congress. I mean, what really sparked some of the sell-off today is what Maxine Waters said earlier. She, of course, a Democrat poised to take over the House Financial Services Committee. Take a listen to what she said.
Make no mistake, come January in this committee, the days of this committee, weakening regulations and putting our economy once again at risk of another financial crisis will come to an end.
Will come to an end.
Yeah.
Deregulation was a big tailwind for the banks.
Right.
And now
deregulation was a big tailwind. I don't think, I mean, the pendulum has swung, way too far, and now, we're swinging back the other way towards less regulation. I don't think we got to the place of, it was way too loosely regulated. Right. I don't think we were remotely close to that. I don't love to see that kind of rhetoric for the banks. I think that was clearly some of what caused the banks to sell off today. The other part, they're being stocks. It was a terrible market for stocks. I'm, like Guy, they each have their own little story of why they're not good. Goldman's sort of on the side. I agree. Citi, we have some foreign exposure there. You would think, okay, what about Bank of America then? Bank of America is very U.S. It is a bank. It's,
U.S. economy is strong, supposedly.
All of that. Bank of America, somewhat disappointing. It's rallied a little in the last couple of weeks, but still disappointing. I'm long Bank of America, Citibank, JP Morgan, frustrated with them each. I don't know that Warren is enough to
Warren Buffett taking
a stake,
yeah.
right, is enough to save the day.
Earlier, up until today, Mel, the banks were actually acting a lot better off the low. The home builders were acting a lot better off the low. The interest rate sensitive areas were acting better off the low. I would put the entire market move today to the Washington kind of comment. What happens in a market with no structure? In other words, you got algorithms, computerized trading, no specialists, no market makers. What happens is you go into a vacuum, and in a comment out of nowhere, when there's really no edge in a retest, you're going to get a whoosh. And that's what today was a whoosh in the banks out of that. Now, just as a real quickie, the senior loan officer survey at the Fed today that was released last night showed that banks eased their lending standards in the end of the month. Think about that. They eased their lending standards, and they said that with a flat yield curve, it has not impacted their lending standards. If it inverts, it will dramatically, but the Fed actually asked the question to the banks. Does a flattening yield curve affect your lending standards? The answer was no.
What about late in the cycle lending standard? Would
Right.
you
Right.
right? I mean, it begs the question: are they easing way too late?
They've been easy. That's the whole thing. Is the lending standards. There's been nothing wrong with credit. In general,
it's
there's
been
been
great.
nothing.
It's been
Credit's
great.
been great. So the fundamental backdrop, you're kind of shaking your head saying, wait, what? And then they come out with the lending survey, which looked really good. And that doesn't mean the stocks are going to go up when you're in a market swoon, but I think today was a lot more about that comment out of Rep. Waters than anything else.
You know, it's funny is that you said a comment out of nowhere, and it was out of nowhere in the sense that we heard the comment today for the first time, but
Correct.
it wasn't out of nowhere
Oh,
in
yeah.
the sense that once Election Day happened and we knew Maxine Waters was likely to take over the chair of the House Financial Services Committee, we knew that this was the likely statement that she would make regarding regulation and the banks, and yet we have a reaction still. Imagine when she actually does something, what the reaction will be.
And maybe that's the time to get in. But, I mean, these banks have been going down a lot longer before that we knew Maxine Waters was going to take any power position in terms of the bank. I mean, they've been going down for by and large, for the last 6 months. It hasn't been particularly good environment. So, again, you have to ask yourself, like the autos, and we've had the conversation, if banks can't rally in the environment that we find ourselves in for the last year, when everything has seemingly gone their way, except for the market over the last month or so, when are they going to rally? And it's, so my earlier point, you have to, at a certain point, you just have to say, I'm wrong, and take a fresh look and say, maybe banks shouldn't be trading at the multiple that I thought they should be trading at. And maybe there is something structurally wrong with that sector.
Are you at that point? Are you close to that point? Are you mentally even thinking
No, I try
maybe
to
they
think, all right,
shouldn't
if I
trade at these
came to this
multiples?
sector today with no history and no feeling like, God, this has been frustrating for a year, for 6 months or a year, I'd want to buy them right here. I really would. I don't know what is between that comment, her saying that, and the point you brought up, to some sort of regulatory change. A lot has to happen between that comment and I don't know that we get there. But, you know, clearly, since part of the reason to own the banks was a new regulatory regime that would be more friendly to the banks, this isn't good, but I feel the valuations are attractive.
Well, and here's the thing is we had the market rallied after the election because we thought nothing would get undone. So it's kind of a little crazy, to Tony's point, to think that one comment today, all of a sudden everybody thinks, wow, now there's going to be all kinds of regulations. I'm not in the camp. I'm more in Guy's camp, where they had massive tailwinds. Now now the tailwinds are going away at the very least, or they're lighter than they were before. How are they going to perform in this environment? And I think that's why people are selling them.
It can't be a sale both ways. You can't have a sale because the regulatory environment's too good and it can only get worse. And then you can't have a sale because the regulatory environment's going to get worse and it can't get better. You can't, in both directions, it's been wrong. I mean, it's been a wrong trade. I've been on it. It's wrong. You can compound a mistake by making it two wrongs. And to exactly Karen's point, if you came in cold here, would you buy the banks? The yield curve is steeping and a little bit off the low. It's likely that the Fed, on the back of home building and some other issues, and inflation break-evens, is going to soften their language in December. Can you imagine? You walk into the end of November, you get a trade resolution of some sort, they shake hands and hug it out,
right?
And then the financials and then you get a lift because Fed Powell says, yes, we're raising rates, but
you're going to get a lift to every
back.
single stock in the market. I'm not convinced. My opinion doesn't mean anything here amongst these traders, but I don't know if the financials are going to have the most torque in that scenario. It won't be the bank
But they haven't had much talk on the downside either.
Until today, they did off the low.
True.
Until today, you were getting a lift in the interest-sensitive stocks. The 2-year note yield has been dropping more than the 10-year note yield, which to me is an indication, given that inflation break-evens are coming down, that the market is starting to think the Fed's not going to be as tough.
So let's think of that best case scenario that could happen in the next month or so, right? There's some sort of trade resolution. And maybe Powell indicates that he's a little bit more dovish or something like that. What rips the most? Technology.
In my opinion, technology rips. Not to say that banks won't rally.
Sure.
But I think if you're asking, I think technology rallies with a 2 beta as opposed to a 1 beta for the banks, in my opinion.
I would say multinationals or EM. Dollar's going to come down. Those are the ones that have been killed. That's the epicenter of this whole thing.
So do you still want to own banks?
I think you got to buy the interest-sensitive names, because the only thing that gets us out of this malaise is going to be a softening of the tone of Powell, because nothing else has worked, including better language in trade.